Still favor stocks over bonds in this type of environment?
I do in this environment because I think while inflation is going to remain high and more persistent than the Fed expects even now, I think growth remains solid. I was very encouraged by today's consumer confidence numbers. So I see stocks dominating in relative terms. The big thing to avoid is the mindset of investors going from relative to absolute. If it goes to absolute, then you get the sorts of behavior that we had on Monday. But as long as it's in relative space, stocks dominate.
Mohammed, you've thought for some time that inflation was going to be a more kind of front and center challenge, and that the Fed perhaps has been waited too long to taper asset purchases, I guess. Where do you see them now? I mean, is the Fed now roughly in tune with what you think both the market expects and the economy needs at this point, given what might happen with inflation as we get into next year?
So late is better than never. So it's a good thing that finally on November 30th, Fed Chair acknowledged that inflation wasn't transitory. It's a good thing that the Fed decided to increase the pace of taper. I wish they had done more. I wish they had done more to reduce the purchases and finish it earlier, because I really don't want to see a series of rate hikes coming at the same time as fiscal stimulus is no longer there, as consumer balance sheets are run down, and as financial conditions tighten. So I would much rather have had them go early, but I'm glad they've moved, but they're not quite where they need to be yet, Mike.
So a lot of people, Mohammed, think that they're not even going to get the opportunity to hike rates at all, or at least as many as 3 times next year, because of what you just laid out: fiscal stimulus withdrawal, financial conditions tightening, the Omicron variant, which, yes, we're not going into lockdown, but is having an impact. We're starting to see on the real-time data, and certainly there are restrictions in Europe and Asia. In that environment, wouldn't inflation come down too?
So inflation will definitely come down. It is why it comes down. There's 2 scenarios. One is the one I think we all wish for, is we get through this supply disruption. It's going to take time, but by the end of the year, next year, we see inflation coming down, and we've navigated through it with a relatively orderly policy adjustment. That's the hope. The fear is that we get a policy mistake. The fear is that it turns out that the Fed did not start early enough, and therefore it has to go too fast. It hits the brakes too hard, and that causes a recession, and that causes inflation to come down. So the first scenario is a good one for markets. The second scenario is not, and that's why it really matters why inflation comes down towards the end of next year.
And what would your expectation be, Mohammed, at this point in terms of where inflation will trend toward, assuming the Fed can, begin the tightening process, and we see we're lapping some of these very hot readings this year, and the supply chain theoretically isn't going to get any worse?
So we're going to be, in the range of 4 to 5.5% inflation for at least a couple of quarters more, and that's measured by the CPI. And then the question becomes, do you get what happened in the 70s, not the level, but the dynamic, which is you get a supply disruption here, that goes away, but that has triggered all sorts of other price adjustments. Already we see cost of living adjustment clauses coming into new wage bargaining agreements. Already we see unions getting a little bit stronger in bargaining. Certainly workers are, they're hopping from job to job. So we're starting to see the inflation dynamics broaden, and ultimately it's whether the Fed is able to anchor these expectations. And that's why it's so critical that the Fed act quickly.
So Mohammed, for those investors here in the US getting a little seasick over the volatility, it's nothing compared to what we're seeing in Turkey. And I wanted to bring this up because you wrote about this in the FT and the crazy, gigantic moves we've seen in the Turkish lira and the government's all-out war to fight it. Why should investors care about this? What is the key takeaway?
So if you think we are facing an uncertain environment, go to the emerging world. They are much more dependent on foreign capital. a lot of which came from the US being pushed out of our markets in search of higher returns. They are more sensitive to global growth, which is slowing because of China. So whatever volatility we feel economic and financially, multiply it by a large number, and that is what it looks like in the emerging world. So if ever this in the emerging world gets to critical mass, it can then spill back onto the US. We're not there yet. China is contained, Turkey is contained, Russia, Ukraine is contained. We just don't want too many of these. So it's good to keep an eye on them to make sure that we don't get that reverse contagion that would then add to our own internal sources of volatility.
A lot of folks keeping an eye on that 65% plunge in the lira this year. Mohammed, thank you. Mohammed Erian. Always good to have you. When we come back.